Welcome to the weekly update, where I'll go over the action in the market for the week of July 22nd through the 26th, and then we'll see how things look for the week of July 29th through August 2nd. Okay, we're seeing a bit more weakness now in the S&P and the NASDAQ 100. Those are the mega caps and the large caps. Those are the indexes that have been really doing well in 2024, and they're still doing really good, even if everything's stopped right now for the year. But we're potentially seeing this real craze going into small caps, and that could suggest that the economy is switching over to a new climate. The encouraging thing that we're seeing right now is that money's not being taken out of the mega caps and put into money market funds. The money's being taken out and redispersed across the stock market. So the broader market is actually holding up a bit better right now. When we go through the daily charts, we're negative in the short and intermediate term. We're kind of right on the fence. We fell below the 50-day moving average only to recapture that in Friday's session. That's kind of the line in the sand between positive and negative. We're looking okay here on the weekly charts as well, and I'll go through them and we'll see how things look. Before I get started, please know that I do videos every day, and this is the real foundation of the analysis and commentary that I do. If you really want to keep up with things, even if you're a long-term investor, we can see these things developing on a day-by-day basis. And there are some things that I teach in the program that I'll talk about in just a moment, where you can protect yourself. That's one of the first rules that I teach is, first of all, we get into the stock market to make money, and kind of rule 1A is don't lose money. Well, there are some things that I teach, and we can know when to put these different things on even longer term portfolios so that everybody else might be sweating it out. We can just be sitting back saying, okay, I know that things are looking all right for right now. I do have a PDF that's available in the description below this video and every video that I post. It's the slides that you see here and the charts that I use. Some folks like to download those and just come alongside of what I'm saying and then look at the charts. You can see them a little bit better sometimes. There are pivot points that I post each day, and I update those on the YouTube community tab. There are two charts. One, the pivot points last for the whole month, but I update it with the new bar for that day. There are intraday pivot points, which change every day. And so I update both of those charts. You might find those useful. I do have a private Facebook group. Now, I talked about a program. That's if you really want to get involved more with the things that I do and my analysis and the things that I teach. If you still kind of like these videos, but you're not really all that interested in the program itself and you belong to Facebook, you can join this private group. There's not an awful lot of activity there. I pretty much just post whenever I upload a video, but I look at it all the time. And if anyone has a question, you want to have some back and forth, you're more than welcome to do that. I do really go through the comments on YouTube and Rumble, and I'm still having to play whack-a-mole on Rumble as folks are attending these online webinars or something about how to be a super genius when it comes to social media and marketing and all that stuff. And I just delete those things. They have this copied and pasted message here, and they tell me how great and wonderful the videos that I have, but I talk about deleting their comments in the videos, so they're obviously not watching them. And I post on Rumble as well as YouTube. This is just to try to get the word out there in more places. It's also used as a backup. Sometimes I'll run into problems with YouTube. Sometimes I'll run into problems with Rumble. So if I'm not in one place and you're looking for a video and it's about the time that I should be posting, go to the other platform and see if it's there. Here is the link to the Rumble channel. Also, I did mention a thing called the SPXInvesting Program. If you're more interested in learning about that program, there's a link to some videos that I've done. It's a playlist on YouTube. There's also a link where you can actually go to the website itself. It's free for right now. I'm going to be locking it down in August. At least that's what I hope to do. And so just come and check it out. There are additional things that I post there that I don't post publicly. And once I lock things down, there's a lot of additional things that I plan on rolling out. And so it will be $97 a month. And So there's a commitment there. And I believe in just being upfront with things. And if I have information that people are interested in, yeah, they'll find a way to do that. But I also have a way set up to cover that. So you don't necessarily have to pay that $97 a month that I talk about in some of the videos. But feel free to check that out. We're coming up to the end of July. We're getting into August now. So the time is getting short where you can just go look at this for free. All you have to do is supply an email address. And the daily videos that I do are the foundation of my analysis and commentary. All the other videos that are around the outside of this diagram, they are weekly videos, and they're just meant to augment or supplement the daily videos, because I feel that's where we get the best analysis. Another YouTube channel that you might want to check out is Shavako Capital. I have no connection. We've never even spoke to each other, but I watch his videos. He posts them every week. He's a money manager where I'm an educator, and it's worth checking out if you haven't run across his videos yet. Also, another YouTube channel that may be worth checking out is Bob Kindle, the Kindle Report. He posts kind of sporadically. We don't really know when he's going to post, whether it's going to be a live version that's posted or if he's going to pre-record it. He also has a newsletter. The newsletter has been $8 a month. Starting in August, that's going to get jacked up to like $19 a month or something. But you might find this useful as well, either to supplement this video, or you might find these guys are better than me, or you might conclude, no, I like the videos that this guy's doing that I'm watching right now. All right, let's go back and talk about this week's session. So for the week, we were down 0.83%. That's for the S&P. We were above average with volume, and we are still looking positive. The one thing that I've really been stressing in the daily videos is we're looking negative in the short and intermediate term, as I mentioned. But when we get to an oversold or extreme negative condition, as we're seeing quite a bit, be careful, because you want to still have the context of the bigger picture going in the back of your mind all the time. Right now, this just looks like a normal pullback or a decline. We're not seeing it. There's the perma bears out there who are predicting the end of the world and the end of the stock market as we know it. But looking at our charts, things are holding up for right now. In fact, it was rather encouraging in Friday's session to see a nice little bounce that we were able to get back above the 50-day moving average. And it's about inflation and interest rates. Now, we had the core PCE come out. That was pretty much in line with what the market was expecting. We've got the Fed. They'll be making an announcement on Wednesday at 2 p.m. Eastern time. Then we have the big employment situation report that'll be coming out on Friday. And a lot of this is going to dictate what the Fed is going to do and how the market's going to react. Of course, the geopolitical concerns, it's like the whole world's going crazy right now, and it's just going faster and faster. I mentioned this in the daily video. Just think of the last 3 weeks and all the crazy things that have happened just as it applies to the US. And it could even get crazier than this. I'm not quite sure how, but nobody really knew how crazy it could get to this point either. So we've got the Republicans already had their convention. Now we've got the Democrats coming up at the end of August. What's going to happen between now and then? It's in Chicago. It had been in Chicago before, but the last time it was really bad was 1968. We had RFK Sr., we had MLK Jr. assassinated in 1968. We did go out to the moon and spin around it 10 times and come back. That was about the only thing good that happened. But the Democratic National Convention was in Chicago that year. And if you're a history buff, and I'm actually a history teacher, you pay attention to these things, and the country just about self-destructed at that point. Are we coming to something like that now? I mean, things are so divisive. Now, I'm just saying this as an informational thing. The stock market is its own thing, and it reacts in its own way, and it's not really impacted unless something will come through to the stock market itself. But still, we want to keep up with these different things that are going on. As far as our trend, it's a weakening trend now. We're starting to drop below the moving average, but it's still positive. The green line is above the red line, but they're both declining, and I'll show you that as well. We're on the short and intermediate term on the daily charts. We've actually crossed over to negative with the trend currently. All right, so here's some bullet points. the stock market was mixed. We had the S&P and NASDAQ. These are the mega caps, the big stocks that have really been driving the market higher. They declined. The small caps, they're kind of finding a little bit of love right now because they like a lower interest rate environment. And if the Fed is getting ready to actually lower rates, this could really help small caps. Now, that doesn't necessarily mean that it's going to ruin the rest of the market. It just means that money is shifting from one place to another place in anticipation of this actually happening. And the Dow also had gains this week. A lot of this was earnings driven because we're about halfway through all the S&P 500 companies reporting earnings. And, it's a roll of the dice, whether the market's going to go or the stock's going to go up or down, and whether that has an impact on the actual indexes. So mega caps and semiconductors, these were really charging higher, and this was leading the indexes higher, specifically the NASDAQ 100 and the S&P 500, because those stocks are in both of those indexes. They're underperforming right now, and that's dragging down those two indexes. Earnings were released by Google and Tesla, and they declined right after that. Interest rates ended up closing at 4.2%, where a week ago we were at 4.24%. So interest rates are coming down, and the dollar is also declining right now, which both of these together usually help stocks to go higher. The core PCE report, it supports the idea that maybe the Fed will go ahead and cut rates in September. I'll show you those charts here in just a moment, and we'll go through those. And then the political news that happened with the change in the candidacy and all that, it really doesn't have much of an impact on the markets. Okay, so for the week, the Dow was up 0.7%. The NASDAQ was down 2.1%. The S&P down 0.8%. The small caps, as represented by the Russell 2000, were up 3.5%. The best performing index right now, but it still has a ways to go. And I have some charts and discussion that I'll make later on with that. This is a chart that I've been showing for over a year. It goes from 1966 to 1982. We're in this area with the blue line still declining, even though the gold line hasn't really been updated yet. Here, this is looking at CPI. I keep showing this every week because we might still decline here, but look at what happened after that. Now, we don't know if it's going to play out this way, but we saw a real decline in inflation in 74, 75, and into 76. And then everything went crazy after that. And we went into a hyperinflation, stagflation environment where we saw super high inflation with really no economic growth. And it was a very difficult time. That's when I was growing up. And it was pretty difficult. Now, is something like that going to happen this time? We don't know. And anyone who says yes or no, or it will or it won't, they don't know. We just have to keep following things as the information becomes available to us, and then we just adjust on an as-needed basis. Okay, then RenMac came out with this chart. I've been showing this for a long time too. Their research a long time ago suggested that when we get above 4.02% with the 10-year yield, that's when it starts biting into corporate profits. And currently we're at the 4.2 level. So it's still having an impact on earnings. This will be updated a week from now. These are the folks that are over 26 weeks, they're over 6 months now, that have been unemployed, and it's starting to go up. And this is what we're going to be keeping an eye on, because it's been the employment situation report that has justified the Fed keeping rates higher for longer. Other areas saw some weakness. Some of the recessionary indicators that we follow were flashing signals, but the employment situation was staying together. And so we're keeping an eye on that to see if that ends up changing. All right, then I go to another site called isabelnet.com. They have some charts that you can look at. It's for free. And I like to update these. I don't necessarily go over every chart that they post. They update their blog every day. It's just, I look at a chart, and if I can figure it out in about 7.5 seconds, I'll use it if it's relevant. If I can't figure it out, it's so convoluted, I just skip and go to the next chart. This is one that I do update every week. These are earnings looking out, whether it's Morgan Stanley or according to a consensus. You see the blue columns going up and to the right. That justifies stock prices going up. Then looking at the biggest 2-week inflow to gold since March 22. I'm not into the cents stuff. This is the biggest inflow since yesterday. I'm not into those kind of comparisons. I look at the chart itself, but they like to do these comparisons. The reason I don't like these when you do a comparison to another time is you don't know what the context was at that time. Now, you may have figured out what it was like in March of 2022, but when they say biggest since 1948, okay, yeah, were we going up at that time? Were we going down at that time? And I just dismiss that, but folks love to do it anyway. So the gold flows, we're seeing a lot of money going in. Just to smooth this out a little bit, there's a 4-week moving average showing that a lot of money is still going into gold. And then U.S. heavy truck sales starting to go back up. We're seeing stronger sales. This could suggest that the economy is still hanging together. Then the yield curve steepens once a recession begins. Okay. Usually what we do is, and we've been dealing with, there's 2 yield curves that I follow. There's the 10 to the 2-year, which is what you see here. There's also the 10 to the 3-month, which some people think that's more important one. I follow both of them. And once this gets above the black line, that means we're back to being normal. And then usually that starts a countdown around an average of about 6 months to see if we're going to go into a recession after that. And we've been under here for a couple of years. It's over 2 years now with the 10 to the 2s. It's coming up on 2 years with the 10 to the 3 months. It's just like, okay, this is just a fact of life right now. But if this ends up going over, man, the financial media is going to be going crazy. The people that are watching this are just going to be really bringing it up. We're getting close. We're getting a little closer to that black line, but we're not there yet. Then, largest calendar year peak to trough. That just means from top to bottom. And these are just looking at times when we had declines in the S&P. And so far, the biggest decline that we've had has been 5%. Then monopolistic, oligopolistic, I didn't know that was a word, dominance. Okay, this is the Magnificent Seven, and just how big do they impact the actual indexes, especially the S&P 500. Even though they're coming down a little bit since we've been under pressure lately, they're still the 34% of the S&P 500. That's why we watch them. In the daily videos, actually, I have the great 8 stocks. I think I included Netflix in there. And I don't have Broadcom, but I do have other charts that we tend to follow. All right, FactSet. This is, I use them for earnings. And they usually have a couple of blog posts here that we can find helpful. They had 2 blog posts this past week. It says, which Magnificent 7 companies are top contributors to earnings growth for the S&P in the second quarter? Well, when you take Amazon, you can see at the bottom, Amazon, Google, Meta, and NVIDIA. They're generating the most earnings growth right now. And then the other stocks that make up the S&P 500, they're quite a bit less. That's why we follow these stocks closely. Then another chart that they posted, this is on a year-over-year basis, where it's really strong back in the first quarter. It's starting to drop off now in the second quarter, and they see this dropping down, but they still see the Magnificent Seven outperforming the rest of the market going forward. And then another chart, these are the top contributors to the second quarter 2024 earnings. This is year over year, where here's Meta, and then we have Merck and Alphabet, that's Google, Amazon, and NVIDIA. And then just comparing with what we're seeing versus what is forecast to go. This is what we saw in 2023 versus what we hope to see in 2024. All right, this is the convoluted part put out by FactSet. And I underlined it last week and I highlighted it in yellow this week. Well, they're both kind of there now. This is the earnings update. As of Friday, 41% of the S&P 500 companies have reported. Of these 41%, 78% have been above their earnings per share estimates. And then they go into the blah, 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 blah. When you take all this together, the companies are reporting they're 4.4% above estimates. There's a caveat with this because there's still more than half of the companies that haven't reported, and that kind of gets figured into this aggregate type of calculation here. I mainly just focus on the first sentence, even first half. No, I guess the first sentence and then the second half of the first half of the second sentence. There we go. All right. Now, we also have an intraday chart where each one of these candles here is 10 minutes. I'm not a day trader. I don't get in and get out, but I really follow what's going on. And we were looking pretty good on Monday. Looks like we were heading higher. Everything was looking pretty good, pretty solid. And then some news came out that really affected the mega caps and semiconductors. It was some news about some increased regulations and sanctions and things like that between the US and China. And Donald Trump came out and said, well, if we're going to protect Taiwan, they better be paying for it. And by the way, why are all the semiconductors being made in Taiwan right now? We should bring that back to the US. You take all that together, and we saw the futures really going down, and that produced a real solid gap lower on Wednesday, and we just started hitting the skids from that point. Then on Thursday, it looked like, okay, we're going to get a nice little bounce here. And we did for the first half of the day, but then we ended up giving that back. We did see a gap higher in Friday's session. And it was actually bigger than what it looks like, because way down here was the close on Thursday, and up here was the open on Friday. And that ended up being about a 1% move up. And then we started to go higher, but then we had a sell program come in. We dropped down below R1 and ended up closing below R1 for the week. So, and this is just the 5 trading days. A lot of measurements that I use go from Friday to Friday. This is Monday through Friday, just to get a little bit different perspective on things. So for the week, we had the small caps looking the best right now. We had the mid caps and the Dow. These have been a little bit of a laggard. The Dow's coming off a recent all-time high. The mid caps were stronger earlier in the year and then turned weak. Well, the small caps have been a disappointment for all of 2024. And then the areas that have been doing the best, they saw some declines this week with the S&P, NASDAQ, and NASDAQ 100. Going back to the beginning of the year, all of the indexes are positive, with the NASDAQ. S&P is now in second place, actually getting a little bit above the NASDAQ 100. Now, that's because the NASDAQ 100 is there's 100 stocks there, okay, where there's 503 stocks in the S&P. And most of those stocks in the NASDAQ 100 are the mega caps and the really big, large caps and the semiconductors, where all of those stocks are in the S&P as well. But since there's more stocks, 503, it's spread out. So it's holding up a little bit better for right now. And then we're seeing the mid caps, the NYSE, the small caps, and then the Dow is actually up the least right now, but they're all positive going back to the beginning of 2024. Looking at the sector, since we had a down week, what I do is this column right here where it says percent change, since we were a down week, I say, okay, what was down the most? And these are the darling areas earlier in the year, just not so much discretionary, but tech was under pressure and communication. These have been the 2 stronger areas. And then energy was virtually unchanged. And then a lot of the other areas really came on strong, like utilities, which could be a defensive play. But that could also be driven by all this electricity that is needed to mine for Bitcoin, and also that needs to be fueling in all this AI stuff that's going on. So that's helping to drive up utilities. But a lot of times we see utilities really rising along with the staples sector, because those are, soap and toilet paper and toothpaste and stuff like that. Things that you have to have no matter what's going on in the economy. And when the market really starts shifting over there, that's the smart money. We watched that. We saw that going into the end of 2021, and then that led to 2022. So we just keep an eye on these things for right now. And then I sort this same chart again according to what's called a scooter score. This is 0 to 100. The higher the score, the better looking that particular sector. Out of all the 11 sectors right now, utilities, financials, and industrials are doing the best. And really, utilities and financials are the only ones that are above 80. None of them are above 90 right now. That's when they're really strong. And then we have communication, tech, and discretionary. These are the growth areas. These are the buy low, sell high areas, and they've been under pressure. Then looking at just for the week in a little different way, we had all the sectors up except for communication, discretionary, and tech. Most of the time in 2024, at least these first 3, tech and communication, they've been the strongest, where discretionary is just kind of floated in and floated out and not really doing all that well. That's mainly because of Tesla. They've been a real drag on this sector. But you also have Amazon that's part of that sector as well. Now, going back to the beginning of the year, we're just very positive here with communication, the financials and tech, and then all of the other sectors. Now, I measure this a little bit different way, so this may vary. I don't compare it to the S&P. I'm just using the raw score for the sector itself. And we have real estate that's been down the most, and discretionary has been under a lot of water as well. Then we look at things in a little different way. This is the relative rotation graph. Think back to your geometry class in high school when you had an x-axis going across, you had a y-axis going up and down. When we look at this, the upper right-hand corner, these are the strongest parts. This is a plus plus, a plus X and a plus Y. Well, we have tech, which has been stronger, but now see how it's starting to roll over. We had utilities that were just screaming, but now they've turned yellow and they're starting to show some weakness. Now, this goes back a year. So this is a longer term chart where we're seeing real estate coming on. We're also seeing discretionary starting to come on. And a lot of these other areas are negative. This is the minus area, but they're starting to turn up as we're seeing some rotation going through the market. And then this is that same information, but just presented in a different way, where the tech sector is still looking the best. Real estate's been improving and discretionary is doing okay. We're more or less neutral now with utilities, and then all these red areas. These are areas that have been showing some weakness. But when you look way over on the right-hand side, if they're turning green, that means they're improving. Then here's another look at a relative rotation graph, but looking at the indexes. We have the NASDAQ 100. This has been the strongest index. Now it's starting to be under pressure. Then we have the S&P 100, which are the biggest stocks in the S&P 500. That's starting to roll over. The S&P itself, still positive, but rolling over. Utilities, which were really doing good, they're just kind of drifting a little bit lower here. The small caps are starting to come on where they were doing really bad. And even transportation, which has been the weakest sector in 2024, because they benefit from lower interest rates as well. They're showing some improvement here. The mid caps earlier in the year, they were up in this plus area. They really fell down. They're showing a little bit of improvement, but they're still not looking all that strong. Okay, and here's that same chart represented in a different way with the NASDAQ 100, the S&P 100, and the S&P 500 looking the best. But we're seeing some improvement here with the transportation, small caps, and utilities. You can see the green. That's showing some improvement. Where we see the Dow Jones Composite Average and the mid caps have been more under pressure, but they are showing some improvement as well. Now, the first chart that I showed you with the sectors, the 11 sectors, that's compared against the S&P. This chart is compared with the Wilshire 5000, a broad market index. All right, sentiment. And I have I don't get political with these videos, but this is something that some of you might find interesting. It's called predictit.org. I don't really put a lot of value into the surveys that come out. Fox News, ABC News, CNN News has come out with a new survey, blah, 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 blah. This, I think, is a little bit more what we can pay attention to because people are actually putting money on the line here. And they're not just going to flippantly answer a question. They're going to actually put some money down, hoping that they're going to see the value of that bet basically going up. And we're seeing a real pickup now that Kamala Harris is the new Democratic candidate, I guess you'd say. The media is just fawning over her right now, and she's getting a lot of publicity. She did get an endorsement from Barack and Michelle Obama, so she's kind of picking up just a little bit here. And Trump was up into the 60s. You notice Biden's not even on the list now. RFK is at a whopping 2 cents. Gavin Newsom and then Ron DeSantis. Not sure why these guys are still on there because now after the convention, the candidate has been chosen. It's pretty much been chosen for the Democrats, but they still have to go through the convention. And with all the weird things that have been happening lately, who knows what will happen next. All right, looking at fear and greed. This is sentiment. Now, we tend to ride it as people are more positive and to the upside, and then we ride it on the way down. It's when it starts to look extreme. That's when we use this as a contrarian indicator. After Friday, we're coming in at 45, which is on the lower end of neutral. This is a historical chart where we were getting better as July was going up, and then we started to hit some problems, and we've been kind of chopping lower. We actually dropped down below 50. So we showed a little bit of improvement in Friday's session, but overall, we are seeing this declining for right now. Then these are the active asset managers. They manage money on behalf of other people. They're professionals. They're supposed to know what's going on, but they're also emotional human beings. They also have peer pressure. They have client pressure, and they don't want to be left behind and actually underperform the S&P. They were getting very optimistic and getting very bullish on things there for a while, and now we're seeing that dropping back down. Here's another reading of that same chart coming in at 76.7. Then we look at the VIX. This is the fear gauge. When the VIX is high, it's time to buy. Why? Because stocks have been going down. And I really think that's a silly rule, but when you're first learning about the markets, and when the VIX is low, it's time to go. Well, we saw a real pickup in the VIX, not only last week. This is a weekly chart, but it was pretty much flat from where we ended a week ago. We're also seeing the bar chart starting to go up as stocks have been under pressure. And this is measured against the S&P 500. There's a corresponding fear gauge for the NASDAQ 100 called the VIXIN. Gotta love that name. I follow mainly the S&P 500 fear gauge. This is another thing, looking at seasonality, where if you look at this red line, and this has been updated recently, where we tend to bottom out with the VIX, where fear gets to really low right around in July. And then seasonally, we tend to see a real pickup in the VIX. Now, usually when this is going up, that means stocks are going down. And so this could mean some pressure, at least into the early to mid part of October. And then looking at the Ulcer Index, this is also a fear gauge mainly used with mutual funds. We're spiking above the moving average on the daily chart. We're just kind of barely ticking higher here on the weekly chart. This is a study that looks at the risky bonds and then with the spread versus not risky bonds. When this is going down, that means the bond market is not seeing an awful lot of fear. And then here's an inverted version of that same kind of thing in a shorter time frame. And this is inverted because it's supposed to match up with the S&P 500, which was going up. And now we've been seeing a pullback. Well, we're still seeing very high readings right here, which is positive with the spread, as the VIX has actually been seeing it's going up, but this is an inverted chart, so it's really going down. Then and I'm just putting this in the weekly video now. I used to cover it in the daily video, but it's only updated once a week. This is the bull bear ratio from Investors Intelligence. These are folks that put out newsletters and make recommendations and all that. This is a bit concerning because we're getting above 4 with the latest reading, and that's when they're getting a little too optimistic. Then looking at the RIDEX bear bull ratio, RIDEX has funds that can benefit when the S&P goes up. They also have mutual funds that benefit when the S&P goes down, and you can switch back and forth between the two. When this is really going up, that means they're getting into the bearish funds. When this is really going down, they're getting into the bullish funds, and we saw a bit of a spike up here. But this particular chart is as of Thursday. There's a one-day lag with this chart. And we also look at the American Association of Individual Investors. That's you and me here. They come out with a weekly survey. We got all the way up almost to this pink 30 level here, and that was just on the border of being extreme positive. When we get really high readings here, we tend to look at this as a contrarian indicator. Well, they really dropped off and we're more neutral right now, but still positive. I also keep an eye on the 50-period moving average, and it's continuing to go up. We tend to roll with that. We tend to see things as more positive as that red line's going up as well. And this is another way of looking at sentiment. We take cash and we compare it to the tech sector. When this black line is going down, that means the tech sector is outperforming cash. In 2022, that's not what happened. And then going into 2023, we're seeing this black line coming down, even though it has spiked up lately as the tech sector has been under pressure. Looking at the economy, we just started a new quarter, so we get the GDP now. Their estimate is just under 3% in the latest reading. When you look at the top 10 and bottom 10 forecasts, we're anywhere from 2.5% to the upside to just a little bit under 1% to the downside. This is another way of showing that same thing. As I always say here, the takeaway from this is notice all of these are positive. They're above zero. One of the definitions that we use as part of determining if we're in a recession or not is negative GDP for 2 consecutive quarters, and these are still looking positive. This is another way of looking at GDP put out by Goldman Sachs. That's the gray bars right here, and then the consensus are the black diamonds. Again, the real takeaway from this is we're still looking positive going forward. Then we look at a weekly chart of the Chicago Financial Conditions Index. When this is going down, that means everything's okay. When we get nervous is when we go above the black line. Then here's another way of looking at that. And I use a longer term chart. This was a little shorter term chart that came out a few days ago where we're actually seeing this going up a little bit, but see where we're still well below the black line. When we go above the black line, that's freak out time. All right. And then this is a big one, and I've been hearing people talk about this. This will get updated when the employment situation report comes out. This is the real-time SOM rule recession indicator. And I don't know why it's real time because it's only updated once a month. But what we're watching for here is in the reading that we're going to get on Friday with the employment situation. If we go above this red line, that's going to be negative. If we stay below this red line or even decline, that's going to keep things more positive. And then here's the smooth U.S. recession probabilities. We get nervous when we're above the red line. We're still below the black line. Then this is a quarterly report. This shows the Brave Butters Kelly leading index where it was starting to go up and causing us some problems. Now it's starting to come back down. All right, looking at inflation with the new quarter here, we had core PCE come out in Friday's session. That's why you see an adjustment over here on the side. This tries to track inflation on a day-by-day basis. Then this is what everybody's wondering about here. As of the close on Friday, it looks like there's a 93.8% chance the Fed is not going to change rates. They're at 5.25 to 5.5 now, and the market is pretty much expecting that not to change at Wednesday's meeting. There's 6.2% that think we are going to get a cut there, but according to the market, it's probably not going to happen. And this is how this has changed from right now, day ago, week ago, month ago. That's pretty much been locked in. This is where the market is really focusing. September 18th will be their next meeting after the July 31st meeting. And now you could take all of these together and they actually add up to a little bit more than 100%. But that just means there's a 100% probability that the market thinks there's going to be a rate cut in September at the 18th meeting on September 18th. Because when you add up 82.2, 11.5, 0.4, yeah, it's a little over 100. But we're at 5.25 to 5.5 right now. They're expecting it to go down to 5 to 5.25. There's even some folks that think we're going to get a 50 basis point cut, and even more that think we're going to go all the way down to 4.5 to 4.75. But taken all together, the market is really expecting a rate cut. If that ends up not happening, look out. That could really cause some problems for the market because they're pricing all this in now in anticipation. And this is how it's changed. They're pretty much locking in more to the quarter rate cut. There's still some folks that think we might be a little bit, and that's almost dropping to nothing, that we might stay the same. And this is going to change between now and that September meeting. There's still some folks thinking we're going to get even more rate cuts than that. And looking at the Fed balance sheet, or if you look at this, it is declining. But if you look at the number from week over week, we're actually going up with the balance sheet. The Fed's in there buying stuff. And then this is looking at a different way at the balance sheet. This uses a year over year basis where it is looking like it's going up, but we look at the number here and it's actually going down. This is another thing that we keep an eye on. If the banks are starting to run into trouble, we might see this really begin to go up. It's been declining and actually going sideways now. So for right now, it's not really causing any problems, or at least the market's not anticipating any problems. Now we get into looking at a weekly chart of the advanced decline line. We're looking good based on price and volume for the time being. I will tell you that on the daily charts, a week ago, I was saying how volume was leading price to the upside. Now we see volume potentially leading price to the downside. It's actually moving more. Now, some of that can be explained because the big companies, people are selling those. And so that generates more volume. And so we also want to keep an eye on the context of what's happening as well. Then we look at the internals with the new highs and the new lows. We saw many more new highs. That's the green versus new lows. We're still going up at the 4-week. We're still going, well, actually starting to turn down here with the 10-week here. But this is still showing the S&P is looking fairly solid. The advanced decline ratio, we do it over 19 weeks and 39 weeks. We're above zero and going up. That's positive. And then this is what I call a smart money indicator, and I use this in conjunction with two other charts. This is a little bit of a concern. We've actually turned negative on the daily chart. We've dropped below the moving average. And the reason why I use this as a smart money indicator, it not only measures the direction of the S&P, it's using volume in its calculation. And we were getting up to an extreme reading. We're starting to drop back. This bottom indicator is called the boom indicator, and it measures how far above or below we are from the red moving average. We actually went extreme negative on the daily chart, and we're starting to bounce up after Friday's session. So we've dropped below the moving average on the daily chart. We're still above it here on the weekly chart. Looking at our trend, this is what I was talking about earlier, where we've switched over to negative in the short and intermediate term on the daily charts. We're starting to drop below the moving average. The black line, that's the actual ADX, that's average directional movement. When this is going up, that means the trend's getting stronger. When this is going down, that means the trend is weakening. I also plot a moving average on here to give it a little bit of context. Then we want to know, okay, the trend's getting stronger. Is it positive or negative? When the green line's on top, that's positive. When the red line's on top, that's negative. And we're seeing the red line starting to come up and the green line starting to come down. They haven't switched over negative yet, where we have switched over negative on the daily charts that we follow. This is the Erin indicator, another way of measuring buyers versus sellers. The green, that's buyers, declined a little bit. The sellers are pegged at the bottom. That means that the buyers are in full control here. The bottom area, that's an oscillator, and it just measures the difference between the two. The mass index is not generating a signal right now. We really only pay attention to this when it comes up to the red dashed line and the blue line. Here's a daily chart where we came all the way down and actually dropped below the 50-day moving average. We were able to get back above that on Friday. And you can see with the moving average at the bottom, we have been above average when we look at volume measurements there. And then this is a thing called the Keller market model. It's David Keller. He's connected with stockcharts.com, where the S&P and the NASDAQ 100 are now in short-term downtrends. All the other indexes, the mid caps, small caps, and all the different time frames continue to be positive. Also, we look at this more on an intermarket analysis basis, where stocks are negative in the short term. Bonds are now turning positive in the short and intermediate term, where they're negative based on price in the long term. We have commodities and the dollar, which are negative in the short and intermediate term right now, as we see this shift going on in the market. Decision Point, they finally had an update here. They probably should have updated their PMO chart too, because I'm seeing where that's turning negative. But we're now looking at a short-term decline according to the trend model. We're still positive with the PMO. That's a momentum oscillator. For the intermediate and long-term, we're still looking positive. This is a long-term chart with a trend channel going back to 2009. We're still well above the midpoint, even though we've been pulling back. This is also a weekly chart. This is somewhat negative. We were able to get above this R2 level and stay above it for 4 weeks. Well, we dropped back down below it, and now we actually closed right on it. Okay, well, we closed at 54.59 on Friday. This line is at 54.51. So what, a 1.5? We're off. But for all intents and purposes, we're right on that line right now. This is a longer term look at the trend. This is a weekly chart of the S&P and then a 50-week moving average. We're still going up with the price of the S&P. The red line continues to go up. The long-term trend is still there. Then we do a moving average crossover with a 13-week versus a 50-week moving average. And we're coming back down to the 13-week moving average. So far, this level has been holding. We're still in a longer-term uptrend. Then we look at a thing called the McClellan oscillator, which has been around for decades. When we're above zero and going up, that's positive. Now, when that's positive, that feeds into a longer-term indicator called the summation index. When it's above zero, the summation index is going up based on price. We actually declined a little bit here based on volume, but we're still positive. Something to keep in mind is volume has been leading things lower lately. Then this is the Swenlin trading oscillator developed by Swenlin. We can break this out based on price and volume. We're still positive, but declining based on price. We've dropped below zero based on volume. See again how volume is leading things, at least looking a little weaker now. This is a bullish percent index, one of my favorite indicators. It's not moving average based, and it's not an oscillator. It measures the point and figure buy or sell signals inside the S&P, and this has actually been holding up better as the S&P has been coming down because it's the mega caps that have been under pressure. The rest of the S&P 500 has actually been holding up better. Then we look at the momentum, the price momentum oscillator. This was also developed by Carl Swenlin. Still looking positive here on the weekly chart, where we're looking negative across the board with all of our oscillators on the daily charts. We came up based on price. We also came up, but dropped down a little bit near the end of the based on a week ago, based on volume. But both of these are still positive. Then there are some additional studies that are attached to the PMO. The PMOs that are rising are showing some improvement, but we're seeing a decline with the buy signals, and we're still going up with the PMOs that are above zero. Now we look at Bollinger Bands, and there's books written about Bollinger Bands. I actually have a book autographed by John Bollinger himself that I bought at a yard sale. Okay, there's no real claim to anything there. What I measure here is called the percent B, and that's when we close above or below one of the upper or lower Bollinger Bands. We did that when the market was just screaming higher. Well, since then we backed off and we're not getting an extreme reading right now. This is still positive since we're above the midpoint. Then here's our momentum oscillators. The top two are short term and they're still looking positive, but rolling over a bit. The MACD, the PMO and PPO, these are more intermediate term. You see how they're starting to roll over a little bit? We're still looking good with the tricks and the KST. These are longer term oscillators where we're pretty much negative across the board when we look at the daily version of this chart. The Chaikin money flow, another smart money indicator, still positive but declining. It's actually negative on the daily chart. Chaikin oscillator, still above the midpoint but declining. We actually are going extreme negative on the daily chart. And so I take the Chaikin oscillator, the Chaikin money flow, and the accumulation distribution, and I put them together in three smart money indicators, kind of using them as a package. The force index is declining, but still above zero, so it's positive. The money flow, after giving us an extreme positive reading, is declining, but still above 50, so it remains positive. The rate of change from this week to last week, we were down, so we're below zero, but down less than we saw the decline a week ago. This goes back 50 weeks, still looking pretty good here. We're above this red dashed line. Sometimes we make note of that to mean maybe we've gone up a little too far, too fast, but we've been just dancing sideways lately. This is relative strength. I have some daily charts that I use. This is a weekly chart. After being extreme positive, we are declining, but we're still above 50. Here is a longer term oscillator called the Special K. It's trying to improve, but still has yet to cross above its moving average, where the daily chart continues to be positive. The Stochk RSI, after being extreme positive, has been declining, but we're not quite extreme negative yet. Then I have two charts here. This is the Williams percent R. This is a weekly chart. And when we're really going up, we can stay pegged at extreme positive readings for a long time. And this is coming down after it had been showing some real good momentum. This is actually a daily chart because I also show this in the daily videos, where when we look at this Williams percent R, we're starting to get to an oversold condition. Now, the reason why I bring this up is that there are times, like back in 2022, when we can stay down here for a long time. But this is when we were in a downtrend. And then we came up out of that and we spent most of our time being extreme positive. Then we had a little problem back in May and going into April and into May. And then we spent some time being extreme positive. Now we're coming down and being extreme negative. Because the bigger context is an uptrend, beware that this may not stay here for very long. It may start to bounce back up. Then here's the ultimate oscillator, declining but still above 50. The vortex has the green line on top and advancing, and the red line's declining here and well below the green line. We've actually turned negative on the daily chart. This is another primary indicator that I use. I have primary and secondary indicators. The primary indicators are what I mainly use to make decisions. I use the secondary indicators just for confirmation. Then the Copic curve, we're negative on the daily chart. We're still positive here on the weekly chart. And we came down and actually dropped below this 10-week moving average here, which equates to a 50-day moving average. but we were able to get back above that. So far this support level is holding. Then we look at an equity put call ratio, and we look at a 253 period simple moving average. Why 253? That's roughly the exact trading days that we see each year. This is starting to go back up, which tends to be more negative. When this is going down, that's positive. We also look at the VIX, and then we take a 3-month average of the VIX and do a ratio between the two. When this is going down, that tends to be more positive. We started to see this going back up recently, and that's more negative. Then we have some different ways of measuring trend here. This is called the Heiken Ashi, where we're actually showing a dark candle right now for the recent week, where we were seeing open candles. That's positive. Black candles are negative. We're positive here with the Kegi chart when we're black, but now we're pointing down, so it still has a negative bias, even though it's positive. The Renko chart has open blocks here, and that is positive. The 3-line break is also positive with the open candles. And we look at a thing called the ease of movement. And the reason it's in this section, because it's really the top portion of the chart called equivolume, where it tries to measure price. And then the thicker the candle, the more volume went into that move. If it's a green candle, that's positive. If it's a red candle, that's negative. What I focus on the most is the 14-period ease of movement. That's the path of least resistance. Is it up or down right now? According to this, the path of least resistance is still up. Then we look a little more negative here. This is a point and figure chart that I alluded to earlier. These charts just take price movement into account and disregard time completely. So these things can happen in an hour. It can take a year for this chart to actually change. We've been really screaming up. When we're going up, we see X's. When we're starting to come down, we see O's. We don't have a signal that's been triggered here. So far, this is just looking like a pullback. Another momentum study, very long term. This is a weekly chart on top where we have a long-term PPO. That's another momentum oscillator starting to come down, seeing a little bit of weakness in the intermediate term and also starting to turn negative in the short term. These are some of the warning signs that we're paying attention to. The 50-day cycle, the last cycle started on June 4th. We went up. Now we're starting to come down. I don't put much weight into this. It's just kind of interesting to see how this plays out. Then we have the Elder Impulse System. When we're positive, we see green bars. When we're negative, we see red bars. When we're neutral, we see blue bars. And that's what we're seeing right now. Parabolic SAR, another primary indicator. And notice right here, we've already changed over negative on the daily chart. We now have a dot on top with the weekly chart here. And this could be significant. Just something to be aware of. Then the broad market. This is a seasonal chart going from 2020 up to 2024. We're focused on the month of July, where it's looking like it's been up 80% of the time since 2020 through 2024, with a return of 4%. Then this is just a weekly chart of the S&P on top, where we're starting to pull back, seeing a little bit more strength here with the mid caps and a lot more strength right now with the small caps. We look at the Dow, and what is the trend of the Dow right now? The blue line's above the red line. That's a positive trend, and we're still above the blue moving average, which is 13 weeks. We're positive with the NASDAQ. Even though we came down to the 13-week moving average, we're pretty much right on it at this point. We look at the NASDAQ 100, also just a little bit below its 13-week moving average, as this index has been under more pressure. Here's another look at the QQQs, which was the ETF for the NASDAQ 100. And I pointed this out a few weeks back. When we go up and we open and then close for the week at just about the same point, sometimes that can signal a reversal. And up to this point, that seems to be what's been happening. Then the mid caps showing a little bit of love lately, looking like they're in a solid uptrend. Small caps still have not broken out above previous highs yet, but showing a lot of improvement after being range bound for all of 2024. We saw a nice little run up at the end of 2023, a thing called the January effect. But then January got here and we've just been going sideways ever since. Now we could potentially be breaking out, but I have another chart later to show you, so don't start licking your chops at least yet. The NYSE, this is a broad market measure, a weekly chart, still looking positive. And this is a daily chart of the Wilshire 5000, came down, got a little bit below its 50-day moving average, was able to get back above that on Friday. All stocks, which takes stocks in the U.S. as well as international stocks, pulling back but still above the moving average. 30 biggest software companies never really broke out here the way other companies have been doing, but still above both of the moving averages here and in an uptrend. The FANG index, Facebook, Apple, Amazon, Netflix, Google, NVIDIA's in there. They've even added to it, but I still stick with the name FANG. We're coming right down to the 13-week moving average, wondering if this level is going to hold. ARK, a very popular ETF, which has been very disappointing going back to the beginning of 2021 for folks. It's just not been participating lately and is looking better. We could be seeing a golden cross here, but it's still in a downtrend. The banks have been doing quite well lately. In fact, we break this out on a weekly basis. Looking at the RSI, we're getting extreme positive. The momentum was starting to look more weak. Now it's starting to turn back more positive. And these are the deposits going into commercial banks. We actually saw money going in, even though this chart has pretty much been going sideways. And then we look at what's called Dow theory. And pure Dow theory just looks at the Dow and the transports. I include utilities in the overall mix, where we're coming off of a recent all-time high with the Dow and actually had a good week last week. The transports have been really lagging. If we're switching to a lower interest rate environment, this could end up helping the transports. And the utilities, as I mentioned earlier, they may be going up because there's so much more need for electricity, or because interest rates are going down. And these companies do so much borrowing, they benefit if interest rates do fall. Looking at the broad market, the commodities, and here's a breakdown of what makes up the CRB index, really showing some weakness right now here on the weekly chart, dropping below both moving averages. Oil, which had got back up into the 80s, is now dropping into the high 70s. Copper, which is a barometer of the economy, it had been really going up. Now it's starting to come down as the market may be anticipating economic weakness going forward. Here's the dollar, which continues to be in an uptrend, both on the daily chart and here on the weekly chart, even though it was down slightly for the week. Gold, which, there's people that just think gold is everything. And there's something to be said for that. It's an actual physical asset. It was worth something 3,000 years ago. It's worth something today. It'll be worth something if we're still here 3,000 years from now, but it's really been more range bound lately. Silver, another precious metal, actually dropping below its 13-week moving average, but still in an uptrend. We keep an eye on the price of bonds, which have been showing some improvement as interest rates have been going down. And this is a monthly chart of a ratio between stocks and bonds. Even though it's ticking down, when this is going up, that means stocks are outperforming the price of bonds. Here is a daily chart of how the yields overall have been falling, and that has been helping stocks. This is a weekly, this is a daily chart. This is a weekly chart internationally, where we have US and UK rates, which are the highest. German rates are blue. Japanese rates are in red. Some relative studies. And then I have a whole nother video after this called intermarket analysis video, where I base things around this chart and then a lot of additional studies. Where now we're seeing where it looks like stocks are in the lead. That's the black line. Oil has been dropping off. That's the red line. And gold is somewhere in here. It's kind of hard to see. And then we look at the dollar. That's green, still holding up. But the price of bonds, even though they've been improving, are still negative going back to the beginning of 2024. Then we look at some ratios. The NASDAQ 100, which had been doing well against the S&P 500, also doing well. Well, lately we've been seeing this coming down as the NASDAQ 100 has been underperforming the S&P 500, but we still see the blue line above the red line longer term. The S&P 100 has been just really outperforming the S&P 500, but since then has been pulling back. Growth to value. Growth is buy low, sell high. Value is more things that you have to have, toilet paper, toothpaste. When the market is afraid, because some money managers, they can't jump into a money market fund. They can't jump over to a different market. They have to stay in different areas of the stock market at all times. And so if they're getting concerned about things, they go from a growth stance over to a value stance. And we've been seeing growth has been outperforming, but lately it's been pulling back. We'll look at a ratio between gold and the S&P, still just kind of chopping more or less sideways here. We look at another ratio between gold and the dollar, where this finally broke out above this trend line, but not really performing with any strength currently. And then we look at a weekly chart of bonds versus stocks, kind of an inverse of what we just looked at. When this green line is going down, that means bonds are underperforming, even though they did outperform in the latest week. And we look at low volatility stocks. This is another area that the market gets into when they're worried about stocks being under pressure. And we do a ratio between low volatility stocks and the S&P, still really underperforming, but bouncing back up as of late. Then we look at discretionary, the things that make life fun versus staples, the things that you have to have. This is an area that has been a disappointment in 2024. We like this to really go up. That helps the indexes to do better. It's been floundering around a lot in 2024. Then we do another ratio between the energy sector and the tech sector. When this is going down, that means energy is underperforming tech. That also means tech is outperforming. But we're seeing a little bit of a bounce up here, but not enough to change the trend, showing that tech has been under weakness lately and energy's been performing better. This is a new chart, and I also have a daily version of this that I'll be going through in the intermarket analysis video and then on an as-needed basis in the daily videos. This is the small cap. Now, I've had this chart for a long time, but I haven't seen a real need to break it out because small caps have been so disappointing. This is a ratio between the small caps and the tech sector. Okay, when this is going down, that means the tech sector is massively outperforming small caps, and it's still doing that. But with this little love we've been seeing coming into the small caps, we are bouncing, but not enough yet to turn the longer term trend positive. And we're seeing pretty much that same thing on the daily chart, an improvement, but the overall trend has not changed when we look at this ratio. Then we have some longer term cyclical. Okay, let me try that again. Secular, that means decades, usually very long term, bull market or bear market. Cyclical is kind of what we saw in 2022. That is a bear market that lasted for a while and then got finished. All right, this is the NYSE breadth thrust, and that's when we hit the bottom, was October 2022. Then this is kind of interesting. This is the ZWAG NYSE breadth thrust. And we're still working off of some signals that were generated here. These usually stay on the books for a year. The last one we saw was at the end of October, beginning of November. So we still have a few months of that. But what I'm seeing interesting here is, first of all, we almost had another one triggered on April 15th, but we didn't hit it in time when we go above this red line. We missed it by 1 day. The other interesting thing here is we didn't generate a new signal, but look at what a high reading we got here. And this is just about the time we started to run into problems with the mega caps. This shows all the statistics of the ZWAG, and it's a guy named Marty ZWAG, who's since passed away. It was one of the very first investment books I ever read. And this just shows you what the statistics are, but we don't know what this actually plays out a year from now. This is another way of measuring buy versus sell. This is the Zohorchak method, and we're on a full-on buy signal right now. If this drops down and actually starts to go negative, that's when it turns into a sell signal. This is a long-term chart of the S&P going back to the 1987 crash. We're still well above this long-term trend line. This is that same chart, but just blowing it up going back to 2018, where we still could fall a lot further and still be in this longer-term uptrend. Then we look at the new highs minus the new lows on the NYSE. Now, what this chart measures, because I have another chart that looks at the raw daily scores, whether it's up or down. This is a 50-period moving average of those daily scores. When we're going up, that's more positive for the broader market. This is based on the S&P 500. It's actually starting to decline a little bit, but we're still well above zero. So we've been positive for quite a while. This is a weekly chart of the NASDAQ 100. We're starting to come down to this trend line here, going back to 2009. We'll be keeping an eye on that. This is a ratio between the NASDAQ 100 and the Dow. And we started to go above these previous high readings. Now we're starting to come back down. Another ratio are the QQQs to the small caps, as represented by the IWM. This had been really going up as the mega caps were outperforming. Now we're starting to see some weakness here. Another chart, weekly chart, that we will be keeping an eye on. Then we also do another ratio between semiconductors, a huge part of the tech sector, and compare it with the Dow. This is also showing some recent weakness after giving us very high readings. Then we look at a cumulative measurement of the new highs minus the new lows on the NASDAQ. It had been declining for years. Now it's trying to stabilize and go sideways. This is an example of a daily score here, where if we're positive, we're above zero. If we're negative, we're below zero. Then we look at the 3-month yield. The reason we watch this is back in 2007, we were about at these levels, even a little bit below it. And then we had the great financial crisis, and this just fell off a cliff as the Fed was stepping in to try to stimulate the economy. Right now, we're drifting lower, but we really pay attention to this if this massively starts to go down, and it's just not doing that right now. Then we have a thing called the Hindenburg Omen. And for a long time, I dismissed this because it's something that the perma bears love. And just so you know, if you're new to these videos, I'm not a perma bear. I'm not a perma bull. I'm a perma realist. There are times when the market goes up. There are times when it goes down. So to always have a stance, no matter what the evidence is telling you, I think is pure foolishness. And if you look at a long-term chart, stocks go up about 70% of the time and they go down 30% of the time. So if a person is a perma bear, that means you're starting off being wrong 70% of the time. Might work really well in baseball, but it doesn't work very good in the stock market. If you want to learn more about the Hindenburg Omen itself, you can read all this garbage here. What I'm looking at here is the chart, and this is put up by stockcharts.com. They take all the criteria for a Hindenburg Omen and put it into one indicator. The warning here is there's a 1-day lag on this chart. We had the initial spike up, and then we came back down. What we're waiting for is between now, this was actually generated on July 9th, but between right now and August 2nd, we need to see another spike up for this to be a valid Hindenburg Omen. So what does that mean? Look at other times when we saw a valid Hindenburg confirmed signal. We saw a bit of a decline here back in 2019. This was the COVID crash. This was when we were ending 2021, going into 2022, and then bad things happened after that. So when I use the confirmed version of this, yeah, but there's some perma bears that I kind of follow, and they're like saying we already have Hindenburg Omen signals. That's not even true. They're not confirmed yet. And here's another Hindenburg Omen, where we have lots of confirmations here with the NASDAQ, but it just kept going up. Apparently it wasn't looking at this chart. Then seasonality, where we're coming into a weaker time in July. We're actually getting up near the end. We might see a bit of a seasonal bounce here. And this is looking at July with going back to 1950, where it tends to be one of the stronger months of the year. And then we also look at this on a global basis. Also, one of the stronger months of the year is July. Then we look at June, July, and August together, going back from 1950 to 2023 during an election year. July tends to perform the worst, but it's still positive, where we tend to see a good August. Then this is a newer chart, and it's replaced some other charts that I was following, put up by Stock Traders Almanac, where this just shows where we've been humming along in 2024. And this is 1949 to 2023 during an election year. We're like way above this. So what I've been looking at is, do we need to revert back down to the average? Just like we tend to not get too far away from a moving average based on price before we go back. It acts like a magnet or a rubber band. Some of the weakness that we've been seeing may be causing this to revert back to more of an average score that we get for this chart. Then this is looking at June, July, and August in a little different way. This is during a presidential cycle where we tend to be positive during the summer. This is another way of looking at things. Looking at July, where we go back to 1950, that's the yellow area. We go back the past 20 years, that's blue. The past 10 years are green during an election year. All of these are positive, but the election year ends up performing the worst. Then we look at the first half of July, which tends to be the strongest part of the year. Well, we ended that after July 15th. And now we're coming in and finishing out the second half of the year, where we tend to be positive, but the results are quite a bit less. This is another way of looking at that same thing. The first half of July is the strongest. The second half of July just kind of ho-hum, going back to 1950. Then this is the election years, going back to 1950 for the S&P. No real edge here. We're up and down the same amount of times, 9 for 18, 9 for 18 with a return of 0.7. Then here's another look at the S&P and the NASDAQ from 2003 to 2023, where we see good solid returns in July for the S&P. That's black. And we see good returns for the NASDAQ 100. Or is this the NASDAQ? I'm not quite sure, but they do even better in the month of July. Now, this is actually going out into August, where we do see more positive seasonality during an election year, We're up 11 out of 18 times, where we're down 7 out of 18 times, and the return is 1.3%. So thank you. I really hope you found this helpful. Please feel free to check out the other videos that I post. Have a wonderful, amazing, non-crazy weekend, and I will talk to you in the next video.